Good afternoon, and thank you for that awfully kind introduction, Dr. Archer. It's great to be back here in Gainesville. I was here very briefly about a year ago. Saw a lot of these buildings in various stages of construction, and to see the finished product, I have to tell you, it's pretty tremendous to see the evolution of the university, even just in terms of the physical plan, and not to mention you all. It's far different than it was when I was here, when dinosaurs walked the earth. But it's great to be back in Gainesville. It's great to have an opportunity to speak to you all today. I'm very excited to be here. As far as agenda goes, just to set expectations, I don't have a formal presentation per se. I thought instead we'd sort of have almost a bit of a dialogue of sorts. I'll give you a little bit of an overview of what I'm seeing and thinking right now in terms of the commercial real estate debt market, CMBS specifically, some of the challenges that the market faces right now. Then maybe I'll give you a little bit of an overview of what specifically I do with a little bit more detail than Dr. Archer laid out, the team, our involvement in markets globally, and then to the extent that we have time, maybe give you a little career advice and take questions as well. With that, by the way, I'm going to speak at a relatively high level to the extent that I understand there's different levels of familiarity with some of the topics that I've been invited here to speak on. So to the extent that anything goes over your head or you want to stop me, please feel free. I don't mind. Just raise your hand and ask whatever it is that you like. So as far as the commercial real estate market goes right now, the market, broadly speaking, is undergoing a transition period. The commercial real estate, particularly here in the United States, has enjoyed a pretty nice renaissance and resurgence in terms of activity levels, pricing, lending activities, et cetera, over the post-crisis period. It seems like what we're entering now is potentially a bit of a transition period where a lot of the trends that have been pretty prevalent over these last couple of years are either slowing or in some cases changing direction. So what do I mean by that? The way I generally think about the CRE market is I generally like to divide it into sort of two sections. First, fundamentals, so macroeconomic growth, inflation, how that manifests itself in terms of the level of rent and vacancy rates across the country, across the different property types. Secondly, the financing environment, the state of it, the aggregate amount of lending, who's lending, what are they lending on, what are they lending for, et cetera. So starting with the first, broadly speaking, CRE fundamentals are healthy. There's not much of an argument about that. We've seen pretty robust recovery in rent and a decline in vacancy levels, particularly among multifamily properties and hospitality product. Those have really led the resurgence in the market, and they've done so for different reasons. Tackling first the multifamily sector. So the apartment sector, which I'm sure a lot of you in the audience are pretty well familiar with living here in Gainesville, has a lot of things going for it. First, there's just been abundant liquidity in terms of the financing environment. The GSEs, Fannie, Freddie, Ginnie, control roughly about 95% of the origination for multifamily loans right now in the country, and that's largely been the case over these last few years. Just to give you some context in terms of numbers, a lot of the loans that they originate ultimately get securitized through the agency CMBS market, which is what we call it. Most of the classes in these transactions are guaranteed. They're wrapped by Fannie or Freddie. There are some credit bonds that are not guaranteed that trade more analogous spread terms to comparable non-agency conduit product. But the agency CMBS market broadly has existed for 25 or so years. Pre-crisis, there was generally around $5 to maybe $10 billion of annual issuance across all three GSEs. Last year, there was about $100 billion that was issued. The size of the market, so the outstanding amount of securities in the agency CMBS market, similarly averaged about 25 to call it $40 billion from around 1990 till about 2008. Today, the agency CMBS outstanding is about $400 billion, so almost equivalent to the entirety of the non-agency CMBS market, including both conduit and large loan single asset securitizations. Needless to say, that's a pretty astounding rate of growth. There's a lot of challenges in terms of how that manifests itself on a go forward and the implications for multifamily as an asset class, but maybe we'll table those questions and topics for a little bit later. So circling back to the fundamentals, so that's certainly been the availability of financing for multifamily through these GSEs has been a huge tailwind. Secondly, the stress that we saw in the residential market coming out of the crisis and all of that which it entailed in terms of price declines, contraction of the availability of capital, much higher standards in terms of banks, in terms of who they would loan to and at what leverage points, where they would lend, what markets they would lend to and in. All of that led to a pretty massive contraction, not just in pricing, but simply the amount of folks that own single-family homes. So right now, I was just telling a smaller group of students a little bit earlier today, if you look at the share of home ownership rate in the United States today, it's at multi-decades lows. It's been about 40 years since we've seen this low a level of home ownership rates in the United States. Part of that is obviously a function of the trauma of what we went through. Part of it is a function of folks just not being able to qualify for mortgages. But part of it, I think, is also a function of the fact that even people that can qualify for financing for a purchase of a home right now don't want to. They're either enjoying the flexibility that renting provides in terms of their lifestyle, or they don't want to make the financial commitment that owning a home entails. So all of those factors have combined to lead to a pretty dramatic increase in rental rates for apartment markets all over the country on the order of, call it, 5 to 6% per annum over these last few years. Pretty extraordinary amount of growth. Similarly, vacancy rates nationally are in the low to mid 90s. Again, historic in terms of the stability of those types of occupancy rates. And what's really interesting is the uniformity in which we see those types of numbers. You see it almost in every MSA, every region of the country. So as a result, the apartment sector, broadly speaking, has done very, very well. We've only recently begun to see signs of construction, which I'm sure a lot of you were thinking, well, if the market's that great, why are there not more cranes out there? And we're beginning to see that. But even in terms of the construction activity that we are witnessing, it's been a pretty local phenomenon in specific regions of the country. It's not yet widespread. So for all of those reasons, our view, my view, is that we're going to continue to see pretty positive performance in the multifamily apartment sector in the U.S. for the foreseeable future, albeit at a slightly lower growth rate than what we've observed over the last few years. In terms of hotels, hotels also have performed spectacularly well, although it's a little bit different fact pattern in terms of the reason why. If you think about the hotel industry, at its base level, what is it? Hotels are effectively just a levered bet on U.S. GDP, on economic growth, right? Because who rents hotel rooms? People on vacation, people traveling for work, and conventions and groups. So all of those have rebounded strongly over these past 8 years or so coming out of the crisis. Hotels, like multifamily, have not had a widespread boom in terms of construction activity. Again, We've seen some signs more recently, but it's been a very local phenomenon. Specifically, Manhattan, we're starting to see, a pretty meaningful amount of hotel rooms coming online in the next 18 to 24 months. But nationally, it's a pretty low number. So, RevPAR increases, which is a measure of the occupancy rate and the average rate that a hotel can charge for their rooms, has increased in the high single digit, low double digit range, again, over these last handful of years. Starting to see some slowdown as GDP in the US, trends lower towards the 1.5% range, which we seem to be averaging right now. But again, the operating leverage that's embedded in hospitality product is such that should still translate to a mid-single digit type of increase in terms of RevPAR and by extension, net operating income. So those have certainly been, the leaders in terms of performance. What about everything else? Well, you have the office sector, which I would describe as a much more of a middle-of-the-road type of performer, certainly relative to hotels and apartments. Office has had a lot of struggles. There was a lot of construction leading up to the crisis. Clearly, the decline in employment that we witnessed in 2009, 2010 took a long time to climb out of that hole. It's really only been recently that the unemployment rate in the U.S. has dropped back down into about the 5% range, which is where we are now, and seeing robust job growth on the order of 150 to 250,000 jobs per month. So a lot of markets struggled pretty significantly with a lot of excess supply coming out of the crisis. Quite frankly, a lot of those markets have only recently begun to stabilize. Rental growth for a lot of those markets is barely meeting inflation. Let's call it 1-ish%. And it's difficult to imagine a scenario, at least in the near term, where that's going to trend much more positively anytime soon. You have seen, pockets of strength, particularly in the coastal markets, places like San Francisco, places like Washington, D.C., Manhattan, Boston, to some extent Los Angeles. But really the interior of the country, at best, has been a stable performer. The retail sector has been one that I'm sure a lot of you have read about or discussed in your classrooms. The retail sector has definitely gotten a lot of press, particularly the poor performance of a lot of regional malls. I'm sure you've seen it. If not, you should definitely check it out. There's a website called deadmalls.com. If you really want to get a deep dive on case studies on how mall product goes wrong, you should log on later and read through some of these things and check out some of the photos. It's quite sad. But we've definitely seen great performance in terms of what I would call fortress malls. So these are Class A plus assets in places and well-to-do suburbs, Las Vegas, things of that nature. The Forum Shops in Las Vegas is a good example. Santa Monica Place out near where I live in LA is a good example. Bell Harbor down in Miami Beach. Those are examples of these fortress-type malls which have done exceedingly well. You could get a good proxy for the performance of those assets looking at publicly traded REITs like Simon, SPG is the ticker, or GGP, General Growth Properties. Their portfolios are comprised of these types of malls. You could see the performance in their share price. You could see the performance in their revenue and income. They've had a pretty good run. The B and the C product, the Class B and Class C product for those regional malls, not nearly as much. That's really where a lot of this narrative that you see in the Wall Street Journal has appeared. A lot of stress being put on through online retailers such as Amazon on discount big box shops like JCPenney, Macy's, etc. All of these firms are having a lot of stress right now and challenges in their business model. They've been shrinking their physical footprints in a lot of these markets, and that in turn then has caused a lot of stress on the owners of these properties. Similarly, if you you think about the impact of all of that on the smaller stores, the inline stores. So those are the stores that kind of run along the hallways that connect anchor A to anchor B. A lot of the leases for those inline tenants have what they call co-tenancy clauses built into them, which effectively say if JCPenney is the anchor of the mall and JCPenney goes away for whatever the reason, they have an option to either terminate their lease early or renegotiate the rent and or the lease end date. All of those outcomes are bad, again, for the mall owner. So a lot of what you're seeing on TV and in the newspapers, et cetera, is a function of that. The bread and butter retail product, let's call that power centers, grocery anchored retail centers, et cetera, more of your neighborhood kind of shopping experience. Those have been okay. I would equate those more similarly to the office product that we were talking about. Nothing spectacular to the good or to the bad, but roughly speaking, steady as she goes. Also similarly, have not seen a tremendous amount of construction activity for those types of assets. So what does that leave us with? It leaves us with industrial and warehouse properties. Again, not a lot to discuss there. Not a lot of construction. Performance has been remarkably stable. Ironically, although the retail sector has sort of had the challenge of online shopping experience really brought to their doorstep, the warehouse and logistics industry has enjoyed the other side of that, because all of these companies need warehouse space and distribution centers, et cetera, and most of them lease space. Amazon builds their own for the most part, but generally everybody else leases existing inventory. So the performance of that sector has been quite good, and actually there's been some pretty meaningful transactions over the last 18 months or so in that sector, primarily from foreign capital looking to establish a footprint in that space here in the US, attracted to the stability of the cash flows, the predictability of the cash flows as well, because a lot of the leases in warehouse space are usually a lot longer than what you have in retail or office, and certainly multifamily and hotels, which are clearly much more short-term in nature. So seeing a lot of stability and interest among foreign pockets of capital for those types of assets. So that's broadly the fundamental backdrop. I think so long as the US economy continues to perform as it is right now, which again, let's call it a 1.5% type GDP, 150 to 250,000 type jobs every month, inflation that's hovering around 0 to 1%, accommodated monetary stimulus for the foreseeable future. All of those trends that we've just discussed are going to remain intact. So that's great. On the financing side, it's become a little bit more of a bumpy road. The financing side, we've seen a couple of different things. Starting first with CMBS, which is really what I traffic in on a day-to-day most regularly. CMBS market, as I was saying about the agency CMBS market, has had a real resurgence in activity over the post-crisis period. We went from $230 billion of private label, non-agency issuance in 2007 to about $5 billion in 2008, $10 billion or so in 2009. And last year we got to about $100 billion. So we've definitely seen a pretty big uptick in the amount of issuance coming to the market, although we're still a little bit less than half of where we were before the crisis, which, by the way, I'm okay with, and I think you should all be as well. So that's been good. The problem with CMBS is a function of capital markets. And people like me and my competitors, we're benchmarking ourselves to other risk assets like emerging market or the high yield corporate debt market. And when you have the kind of turbulence in financial markets and conditions that you experienced or you saw in January and for the first half of February of this year, it causes a lot of questions to be asked among investors, among management, and it causes a pretty dramatic slowdown in origination activity. And that's exactly where we are right now. So coming into the year, most street analysts had expected about $125 billion of non-agency CMBS issuance this year in 2016. Right now, we're at about 20, so we're halfway through April. My personal expectation is if we got to 50 billion by year end, that would be a tremendous win for the industry. We're actually now beginning to see those same analysts that were calling for 125 billion of issuance in November and December now begin to cut their issuance targets, although they're not quite cutting it as severely as my opinion, but they're going that way. So, what does that mean? Well, it means a couple of things. For one, if you think back just in terms of timeline. So I mentioned that the overall amount of issuance that we saw in 07 just for CMBS was almost $250 billion. 06, it was less, but not that much less. It was about 190 billion in 2006. CMBS loans, as I'm sure a lot of you are aware, generally are 10-year fixed rate loans. So that means that a lot of the legacy loans that were done at the very peak of the market in late 2006 and 2007 are beginning to mature right now. They're maturing right now in a time period where there's a lot of questions in terms of the economic environment, the viability of the credit cycle and where we are, the ability of central banks to continue to support easy financial conditions, and a CMBS market that is at best tapping the brakes. Not a great recipe for an outcome. Away from CMBS, you have banks, which are still pretty active in terms of lending, and actually picking up pretty meaningful amount of market share at that. You have insurance companies, which, to my knowledge, every year since 2010 successively have set a new record in terms of origination. They're on pace to do so again in 2016. The problem with insurance companies is, I guess, twofold. One, there's a very narrow band in terms of credit profile that's acceptable to an insurance company. One, it has to be very high quality asset. So the fortress malls we were talking about, Class A office product in gateway markets, New York, DC, San Fran, Chicago, LA, what have you. They also will only originate generally up to about a 60% LTV. No transition loans, no bridge loans, no mezz, no B notes. So it's a very, very narrow. Now, what fits in that bucket is pretty large, but what fits in that bucket isn't really what needs the help. That's not the legacy CMBS product that needs to be refinanced. That's not the bank portfolio product that needs to be refinanced. So insurance companies are making a lot of loans, but they're only helping one segment of the market. And the second problem is insurance companies generally front load their origination activities in the first half of the year. So coming into the year, they get a set budget in terms of how much they're allowed to originate over the preceding year. And then that's pretty much it. You get to that number, and then you shut it down. And given the velocity that we've seen in terms of origination activity, even these first 3.5 months of 16, it seems like a lot of the major insurance companies are going to hit those targets probably by the middle of the summer, if not sooner. So it's very likely you're going to remove that segment of capital from the market as well. So what do you have left? You have mortgage REITs, you have specialty finance companies, you have debt funds, all of which have plenty of capital. But in the context of the overall CRE debt universe and the amount of product that needs refinancing, it's unlikely that that will be enough. The point of all of this is to suggest that having a vibrant and healthy securitization market for commercial real estate is of critical importance to the continued health of the market, of the overall market. And it's not clear that we're going to have those conditions. Further complicating the issue is a lot of the 2016 maturities for the legacy CMBS loans just happen to be scheduled for the second half of this year. Just bad luck, I guess. So that's another problem. And then obviously you have all of 2017 with about $90 billion of legacy loans that are going to need capital. So you take all of that and then you back out a little bit and just think generally about what you're reading in the news right now, the concerns about economic growth in places like China and Japan, the political turmoil that we're seeing very recently in Brazil, the refugee crisis in Europe and the political implications that has, as well as the ECB's experiment with negative interest rates. And then you have the US over here, which continues to chug along as far as the economy goes, but it's facing a lot more headwinds than it was a year ago and 6 months ago even. And then you kind of bring all that back to this situation that we have with CRE right now, with the legacy CMBS loans that are coming off online or offline, and all of the challenges in terms of finding enough capital. So as I started out, we're undergoing a bit of a transition right now. And I certainly would like to believe that everything is going to be fine. And in my heart, I think that's probably true. However, the potential for some pretty meaningful bumps in the road are certainly there, and the reaction function to those bumps as they come along, as we saw earlier in the year, are not completely clear how that's going to go. Now, all that being said, maybe in part because of all that, it's a really interesting time in the market right now. There's a lot of things happening. There's a tremendous amount of opportunity right now, both in the public debt and private debt markets, as well as on the equity side. There's a lot of interesting ideas and people trying to do things to tackle some of these systematic issues that we're facing right now. So sitting in your seats, you shouldn't be dismayed or saddened by what I'm telling you. You should actually be excited, because what I will tell you is that when everything's awesome, that it feels good, but ultimately it doesn't result in phenomenal opportunities for young people to begin their careers. When you have a little bit of turbulence out there, but not quite a depression like what we saw in 2008, that's usually a much better time to learn and to grow on your career path. So keep all that in mind. In terms of the CMBS market, transition a little bit, talk a little bit more specifically about what we're seeing right now. CMBS, generally speaking, you have the non-agency market I've talked about a couple of times. You have sort of two main subsectors there. You have the conduit deal, which is a multi-bar, it's a pool, multi-bar, multi-loan, diverse geographically, and diverse in terms of property type, et cetera. Today, a conduit deal generally has about 50 to 75 loans in it. The pooled balance is anywhere from about $600 million to about $1.25 billion in terms of size. The cash flows that the properties generate for those loans are used to pay principal and interest for a variety of bonds that get created off the back end of it. The structure of those bonds has been simplified during the post-crisis period. So it used to be in 2006 and 2007, you used to have nearly a dozen AAA securities which got hypertranched. You'd have a 2.5-year bond, the 5-year bond, the 7-year bond, the 10-year bond. You'd have a mezzanine AAA, a junior AAA. You'd have a planned amortization class, which would also be AAA. And then going down even further the credit curve, you'd have a AA+, a AA minus, an A+, all the way on down to B-, and then ultimately the unrated equity tranche. one of the things we did as a marketplace coming out of the crisis was we simplified the structure. So today, you still have a couple of AAA classes with different duration profiles. You have a 2.5 year, a 5, a 7, a 10, and you have a planned amortization class. You have a mezzanine AAA class, but then you simply just have a AA minus, an A minus, a triple B minus, double B minus, B minus, and the equity. So in some sense, that makes life a little bit easier, certainly for investors, rating agencies. And I think intuitively it should tell you a lot about some of the challenges we faced coming out of the crisis in terms of over-engineering of structure, getting too cute with things. So a lot of those issues have been cleaned up simply by collapsing some of these classes into larger ones, which, by the way, as an investor, I would tell you it's a more attractive profile because the thickness of those classes. So to the extent that we have an adverse economic scenario, say later this year or 5 years from now, who knows? And there are defaults and losses in these pools. Having a thicker bond is a lot easier to stomach than the thinly tranched ones that we had pre-crisis. So one of the things that's been also pretty helpful post-crisis for these conduit deals has been a broadening out of the investor base. So, having been a part of this market now for CMBS 1.0, 2.0, and now 3.0, I would tell you that the breadth of the investor base for CMBS securities today is probably the best that it's ever been, and that includes 2007. A lot of the capital that participates in this market today is what we call real money. It's insurance companies, it's large asset managers like myself, it's banks, it's in some cases insurance companies from abroad. There's mortgage REITs, there's debt funds again that are participating, there's hedge funds still, although that's a topic that I'll address in a couple minutes. So the attractiveness of the sector has sort of been borne out by the amount of people and capital that have come into the sector. That said, there are two challenges that we've faced over the last half a year or so, or really maybe more than a year. One is, as the market recovery has ensued, competitive dynamics are such that leverage increases, spreads go down in terms of the originators of these loans, right? People get competitive. The pie is growing, they want to get more share, they want to issue more debt so that they can securitize. So inevitably what happens, the first lever that you have available to you is credit, right? So you go from originating 65% LTV loans to 68, and then 70, and then 72. And then once you get to 72, 74, then you say, okay, I can't really go much beyond that. What do I do next? Oh, I know. Instead of giving you a 10-year fixed rate loan with a 30-year amortization schedule, I'll give you a 2-year interest-only period up front, and then you'll flip to a 30-year amort after that. And then the 2-year period IO goes to a 3-year, and then it goes to a 5-year. I've even seen 7-year period IO loans. So that's one challenge. And by the way, for context, I would say about a year ago now, there are about 40 shops out there that were actively trying to originate commercial mortgages with the intent for securitization. It's a lot. If it sounds like a lot, it's because it is. So that was one challenge. The other challenge, which has been a little bit more recent, has been the change in the regulatory environment. I'm sure you've all either studied it or read about Dodd-Frank and risk retention and all of these Basel III, all of these new initiatives that the government has put into law. the impact, for a variety of reasons, which I won't bore you with, but the impact of a lot of that regulation really began to take effect in earnest, I would say this summer. And, how it manifested itself was, one, a dealer community, so the investment bank trading desks that are our counterparties when we're trading bonds, had the amount of capital, so the balance sheet that gets allocated to them for carrying inventory and trading bonds that they get from senior management was drastically reduced. So dealer holdings, which you can actually look at online, the Federal Reserve Bank tracks it and posts the data on their website, is down by about half from where it was about a year or so back. So that's a problem. Second way it manifests itself on a more personal note is people get fired. I tell you, a lot of people that I know personally and traded with and talked to on a daily basis just lost their jobs. One major investment bank, European bank, which I won't mention by name, decided one day that they were just going to fire their entire CMBS trading desk. No warning, no anything. We actually did something with them the day before and came into work, and the whole desk was gone. So there have been a lot of those types of stories and events that have taken place since last summer. Looking ahead, again, we have an environment now where activity levels in terms of trading volumes, certainly for CMBS, but just more generally fixed income credit, are down significantly. A lot of folks don't want to do anything because a lot of the uncertainties in terms of the economy and monetary stimulus that we talked about earlier. You also had the P&L impact of what happened in the first 6 weeks of this year, which is just as Wall Street is gearing up to their business models and trying to pocket P&L so they have over the course of the year. So the kinds of drawdowns and declines that we had in risk assets in the beginning of this year, not just was the worst that we've seen in 5 years, but it came at the worst possible time of the year for the street. So while we've seen a recovery in pricing, particularly for equities, which are basically retraced everything that they lost in the beginning of the year, and some fixed income credit markets, particularly in the corporate high yield market, the CMBS market, the structured product market more broadly, has been slower to recover, which again creates this negative feedback loop among investors as well as issuers in terms of their willingness to originate more loans for new deals or to trade around existing bonds across the capital stack. So those are the two major challenges that the market faces. I guess the third one I would throw out there is later this year, towards the end of the year, risk retention is supposed to get phased in. And for those that aren't aware, basically what risk retention came from the Dodd-Frank Act that got passed into law a couple of years back. And basically what it says is the issuer, so in the case of CMBS, an investment bank has to retain a 5% interest in the securitization in market value terms. So why is that a big deal? Well, right now the way it works is the below investment grade securities off these conduit deals get sold to what they call a B-piece buyer, which are basically specialty finance firms that only do this. So they go and they underwrite every loan, or they hire people to look at every loan. They visit a lot of the properties. They come up with a pretty detailed model of what losses they expect and what recoveries given defaults might look like. And they buy, in the case of new deals, the BB-, the B-, and then the unrated bonds. Those securities get placed on an unadjusted basis in the mid-teens. So the yield assuming there's no defaults or losses on the pools, we're getting placed in the mid-teens. Today, that's around 20%. So that's what sort of current market practice is. The risk retention says that, A, you have to own 5%, which is actually anywhere from 25 to 50% more than what the B-piece buyers are buying currently. So you have to own more of an investment grade rated security now than today. Second thing it says is you have to own the risk for 5 years. So right now, if Fund A buys a B-piece from some conduit deal, they could turn around after the bonds settle the next day and sell it to me. With risk retention, they can't, or at least they're not supposed to. Thirdly, they're not supposed to hedge the credit of these deals. So there's a lot of different ways you can hedge these risks, one of which is through something called CMBX, which is a synthetic market that tracks these conduit bonds from AAA down to BB. It's a pretty liquid and actively traded market at this point. It's more or less replaced the old ABX market, which was sort of the subprime synthetic market that everybody that read The Big Short and all those types of books or just watched the movies, that's what they were talking about. So ABX doesn't really exist anymore, but CMBX does now, and there's about $1 billion a day that gets traded through CMBX. So you can't buy a B piece and then go short a bunch of CMBX contracts on the other side of it and lock in some kind of arbitrage. Not supposed to do that. Now, there are a lot of challenges in risk retention because everything that I've just said, the law doesn't tell you what happens if you don't. So what happens if you sell it before the 5 years? What happens if you hedge it? It doesn't say who's responsible for monitoring these things. What happens if you don't? Is there some kind of fine? Is there jail? Whatever it is. So all of those kinks need to get worked out between now and December when it gets phased in. But assuming for the moment that somehow those things do get worked out and the rules stay intact more or less as they're currently defined, that is going to be an additional hurdle. So a third kind of hurdle that the CMBS market and then by extension the broader CRE debt market has to contend with. Estimates that I've done in terms of the impact, so the monetary impact of risk retention, depending on a couple of variables, but assuming that the types of deals from a credit perspective stay constant from where we are right now, you're probably talking about 30 to 40 basis points on a given loan. So what does that mean? Well, it means that if I own a shopping center, that's pretty much fully occupied, stable. I go and try to get a CMBS loan, and my broker quotes me a 10-year fixed rate loan at, say, 5% today. Well, once risk retention goes into effect, holding everything else equal, so same leverage, same tenants, same lease terms, also holding financial markets constant, right? So assuming spreads don't change for all of these securities, that same loan is probably going to cost me now, the coupon's going to be, instead of 5, it's going to be 5.30 or 5.40. Is that going to prevent me from getting a loan? No. But it's not helpful either. And it's going to mean that the debt service coverage ratio, right, is going to be lower, which could limit the amount of leverage I can get. So maybe instead of a 75% LTV loan, now maybe I can only get a 70% LTV loan or 67% LTV loan. To the extent that happens, that's going to be a potential drag on property values as well. So where are the bright spots? Because this has been a pretty negative conversation up until this point in time. So let me at least attempt to make it a little bit more positive. Bright spots have been, at least for CMBS, the large loan securitization market. So the other section of the non-agency universe is what we call single asset, single borrower deals. It's really comprised of two different deal types. One are insurance company type loans. So you remember before I was saying insurance companies, only write loans on sort of these very high quality assets with relatively low leverage. Well, the other limitation of insurance companies are they won't make a loan over a certain size. And even if you can cobble together a couple of different insurance companies on a said loan, the logistics of putting that partnership together are very problematic. So securitization comes into the picture because if I'm GGP and I own the Ala Moana Mall in Hawaii, which is one of the best performing malls in the entire country, and I want $1 billion mortgage, well, I can't just call MetLife or Prudential and get $1 billion. The only option you have is to go to the CMBS market. Coincidentally, a lot of the buyers of the securities for those types of deals actually are insurance companies. And the way they look at it is, well, I love the risk. I couldn't make the loan because it was too big, but I'll buy the bonds and I'll still have the credit exposure, and I might not get the spread that I would have gotten overall if I'm only, say, buying a AAA rated bond, but it still beats owning treasuries. So that is, ironically, a pretty heavy insurance company dominated market. The other part of the large loan, the single asset market, is a little bit further out in the risk spectrum. These are more transitional assets or portfolios. So these are typically floating rate deals, short term. They usually use what they call a 5-year non-call 2 structure, which basically means it's a 2-year initial term, and then the borrower has 3 extension options, which are each for 1 year. Usually they get structured with some kind of leverage test or some kind of other metric to monitor the performance, but all of that gets negotiated and every deal is different. And generally what the collateral is well, most recently a lot of the volume has actually been in the hotel sector. They've been a lot of select service portfolios that a lot of brand name private equity shops have purchased, and they have some business plan in place. They're going to spend a bunch of money to renovate the guest rooms or the lobby or put a new restaurant in or whatever it is, and effectively get the performance of the assets up a little bit, at which point they would pay off this CMBS deal, the floating rate deal, and then get more permanent financing. There's been a lot between both of those deal types. There's been a pretty amazing amount of product that's been placed. I want to say last year I think we had nearly $30 billion of those types of deals between the two that got issued. So far this year we haven't seen a lot of the latter, but we have seen a lot of the former, so the high quality stuff. And I think we're going to continue to see that. So we'll continue to have some growth there. I mentioned the agency CMBS market before and the tremendous amount of issuance that we've seen there over these last 6 years or so. It certainly seems, at least from my vantage point, that there's absolutely no reason to believe that that's going to slow down at all. If anything, it's probably going to continue to increase on an annual basis. At some point, it does feel like there'll be a day of reckoning, but that day doesn't seem to be today. And quite frankly, there doesn't seem there's the political will in Washington right now to change the playbook that Fannie and Freddie are using. Does anybody have any questions up until this point? Okay, great. So what else can I tell you? Tell you a little bit about what happened in terms of the market. So you have some context for spreads. So I've referenced a few times this volatility that we saw in the beginning of this year and to a lesser extent in the fourth quarter of last year. So the way CMBS bonds get traded, they get quoted and traded off a spread to swaps, to the swap rate. So let's put aside the single asset deals for a minute and just focus on the conduit, because that's really the bread and butter of the market. That's the bulk of the outstanding CMBS. So new issue, super senior AAA bond, 10-year fixed rate bond. About this time last year, they were being issued in the low 70s, which means that the yield that a bond investor would get on buying the security would be 72 basis points above the 10-year swap rate. Okay. In February, the beginning of February, that was 165. So you went from 70 to 165. So that's a lot. For all the finance students in there, that's 10-year spread duration. I'm not going to pick on anybody, but if you run the math, that's equal to a couple of points in terms of your bond price. Which, imagine now you're an insurance company that owns billions of dollars of AAA rated securities, and in the span of 6 months or 8 months, the value of your portfolio just went down by $50 million. Now your boss just came by and wants to understand what happened, and you have to try to explain it to him. So that's a pretty dramatic event. Further down the credit curve, so for, say, BBB minus securities, so still investment grade, but IG, those were trading, new issue, were trading around 325 basis points about a year ago. That one I remember pretty well because I came into work one day about this time last year, and it just felt like that was really tight level for that type of risk. The credit curve for conduit CMBS was very flat. There wasn't enough slope in terms of how much incremental spread or yield you were getting paid at each successive rating category. So we sold. We had a pretty big portfolio of newer vintage conduit deals. We owned a couple $100 million at the time. And over the span of about a week and a half or 2 weeks, we pretty much sold all of it. And it was all in this 325 kind of spread level. Some were a little wider, some were slightly tighter, but it was all right around there. By year end, those same bonds were now trading in the 450 to 500 range. And in the beginning of February, they were trading in the 800s. Today, they're trading more in the 600 to 700 range, depending on the deal and if it has a major rating agency on it, et cetera. So again, going back to your finance classes, so still 10-year spread duration. You had spreads go from 3.25 to at one point 8.25, and now back to 6.25. So what does that mean? Well, you're talking about 20 points in terms of your bond price, and more for some. So again, do the same kind of scenario analysis. You own a portfolio of $100 million worth of these things across all different deals, all different CUSIPs, and you were marking these things at 90 cents on the dollar, which is pretty much where you bought them. And now your pricing service is telling you that well, we're going to mark these at 70. Now imagine you're not an insurance company, because insurance companies generally don't own those, but you're a hedge fund. And not only are you a hedge fund, but you put those bonds out on repo, right? So you're leveraging those bonds so you can get to your 10 to 15% IRR target that you promised your investors. So you just had a 20-point drop in the asset value of your security portfolio, and you have it levered. What happens is not a pretty picture. And one of the things that we saw in the beginning of this year, and why it was so painful and why I keep bringing it up, is it wasn't just CMBS. You had similar stress in emerging markets and the high yield market, the CLO market, the bank loan market. And those markets had been under some degree of pressure for, in some cases, towards the end of 2014 was when it started. CMBS market had actually performed exceptionally well over the course of 2014 and 2015. So what happened when January and February came was they looked at their books, and the one part of their portfolio that had actually performed pretty well was CMBS. And they're getting all these redemption requests, or they think they're going to get redemption requests, and they need to raise capital. So what do? They sell CMBS. And they sell these BBB CMBS bonds, except there's a tremendous amount of vol in the market. So investors like myself are not very eager to start scooping all these things up. As I said earlier, the dealer community is really under a tremendous amount of pressure right now in terms of the balance sheet that's getting allocated to them, and quite frankly, the personnel that are getting allocated. So they're basically not home. So in that kind of environment, what winds up happening is you fall off into the abyss. And you have results like what I'm describing to you, where you have prices of investment grade rated securities that in the span of 4 weeks, 6 weeks, can drop by 20%. You have equity-like performance, technology stock kind of performance in investment grade rated securities that are collateralized by stable portfolio of commercial real estate. It's pretty scary. And the aftermath of that is one of the things that we're dealing with right now. So hopeful, as I've said a few times now, that the market will adapt. I mean, the one thing I will say is, despite all these challenges and despite some of the headwinds that we face, our industry, there's still a lot of smart people in this industry. We're pretty creative and resourceful. And I think at the end of the day, people understand the value of having a healthy, functioning CMBS market for the broader CRE market. So I am cautiously optimistic that all of these challenges will get themselves worked out one way or the other. And as an industry, as a marketplace, we will come out on the other side. But I don't want to sugarcoat things either. There are a lot of challenges in front of us, certainly a lot more than what we faced, say, 2 years ago. But the backdrop is pretty constructive as far as CRE goes, as far as the U.S. Economy goes. So those are all helpful, clearly. I think I'll maybe stop there as far as CMBS goes. Maybe I'll just spend a minute or two just talking about my firm and what I do and how we're set up, and then I'll open it up to a couple questions. As Dr. Archer mentioned during his kind introduction, my responsibility is I am the portfolio manager for WAMCO's commercial real estate debt platform, which mostly consists of different CMBS securities in all of these subsectors that I've been talking a lot about: conduit, large loan, floater, et cetera. Our portfolio is quite large, many billions of dollars. We actively trade our portfolio across the spectrum. We're always looking for relative value opportunities and looking at all of the holdings that we have and making sure that our clients and the funds that we're managing for them are in the best risk-adjusted securities in our view at that particular time, irrespective of what the market conditions are, whether they're good or not so good as they are today. So there's myself and 3 other folks that work with me. We're part of a broader team which has responsibility for the non-agency residential market. So legacy securities, Alt-A, subprime, option arm, as well as some of the newer product that's getting created, like reperforming and non-performing residential pools, non-qualified mortgage pools, what they call sort of Resi 2.0. We also manage a smaller portfolio of consumer ABS bonds as well, mostly student loan and credit card securitizations as well, which are the latter great fits for shorter duration, stable value kind of mutual funds. And then we also have a mortgage desk, which trades pass-throughs and TBAs and mortgage derivatives as well. WAMCO, for those that don't know, is one of the largest fixed income asset managers in the world. We manage about $450 billion across all of our different strategies. The world headquarters is in Pasadena, which is in the Los Angeles area. But we have offices all over the world, in New York and London and Tokyo and Dubai, et cetera and so forth. One of the great privileges of working at a place like WAMCO isn't just the depth of the capital base, it's the breadth of the capital base, meaning that we manage money for a lot of different types of clients with a lot of different types of mandates. There are some which only want a little bit of incremental spread over treasuries and want very stable, almost money market-like type performance. We have a huge business in core and core plus fixed income mutual funds. We have closed-end funds. We have a mortgage REIT, which is publicly traded. We have separate accounts. We have hedge funds. I mean, you name it, we have it. Our client base similarly runs the gamut from pensions and endowments to sovereign wealth funds, central banks, insurance companies, high net worth family offices, et cetera. And they all have different interests, they all have different risk tolerances, and they're all looking to accomplish different things. So I think more than anything else, what we try to deliver, isn't necessarily just great performance, but it's great performance based on what their needs are and requirements are from a risk perspective. So it's been a great pleasure to work there, and it's a great firm. And if anyone's ever interested in coming out west, I'm sure we'd love to have a chat with you. With that, I'm running a little bit low on time, so I'm gonna just maybe stop here and open it up to any questions. I understand from Dr. Archer, some of you are working on a project looking at the GC6 CMBS deal, specifically the A3 and the F classes, which coincidentally I actually own some of the A3 class in some of our portfolios. So if anybody wants to ask about that, now would be a good time. Yes? Uh-huh. Yeah. Yeah, it's a great question. The short answer is right here. It's the asset manager community, particularly the larger asset managers that have been buying those types of bonds. And if you kind of take your question out a little bit, what does it really mean over the longer term? Well, what it should mean is because you've transferred risk from largely, let's call it that the hedge fund community, which as a function of their business models, don't have the steadiest hands during turbulent times. and you've transferred it to big real money accounts, places like WAMCO and our direct competitors, which theoretically should be able to withstand those types of market vol a lot more than those guys. It should ultimately result in lower spread vol and more stability for the product. But that's longer term. Right now, we're still going through that risk transfer and the transition. And as you all know, transitions aren't always smooth and easy.
So you guys going to be looking to like expand the number of basically hiring off of those creating desks that like where the new outside, but to take a more active role in almost.
Yeah, I mean, look, it's already happening. It's already happening. There are, it used to be, and it still is to some degree, that, a dealer's desk would send out every morning a run of all the bids and offers that they had on their inventory, specifically deals off their shelf. So Goldman issued conduit deals. They would show you bids for all the AAAs that off Goldman deals. Citi, same way. Deutsche Bank, same way. For the more levered risk pieces like triple Bs or some of the legacy securities, which have a higher capital charge that's associated with them for the dealer community, what you're actually seeing now every once in a while is you'll actually have a client. So you'll have a money manager, you'll have a hedge fund put a list of 4, 5, 6, 7 bonds together and send out indicative bid and offers on them, acting basically as a dealer. So you've already started to see that type of rotation, which again, longer term is good and healthier, at least for the market, because they're filling that void, or at least trying to. But the transition has been a little rocky. Some people just simply prefer to interact with a dealer and a salesperson and a trader that they've talked to for years, not to mention the institution. Why? In other words, why do I want to pay bid offer spread to one of my competitors simply because they sent out a market in the morning? I'd actually rather pay it to dealer A, because at least with dealer A, I have an institutional relationship with. They do all kinds of things for me and my firm, whereas my competitor is just my competitor. Sure. There was another question over. Oh, yeah.
Yeah, this might be a little bit less financially literate question, but I was just curious, when you talk about agency CMBSs, how much volume of mortgages do those represent, and how much assets are they typically backed by? What is the minimum level of these packages, and what's the average that these packages?
For the loans or for the deals? So the loans can be small. The loans, could be as low as, $1 million or lower. So the securitization are typically about $1 billion in size. Some are, maybe we're averaging a little bit more, maybe $1.1 billion, but that's typically what they do. And then under the Freddie program, they will wrap or guarantee the first 90%. And then they'll sell off the bottom 10% through, they'll chop it up into a few different classes, but they'll sell it to private investors at spreads which are much, much wider because they're credit bonds. They're not guaranteed by the agencies.
And do those go into that kind of unrated category typically?
It depends. Of the 3 classes that they issue, one of them is unrated and goes through a similar process as to what I was describing with the BP spires on the conduit CMBS deals. The other 2 are more senior and do get rated by the rating agencies, usually triple B. One's minus, one's plus. Yes? Mm-hmm. Mm-hmm.
Companies, do you see the increased prevalence of those alternative sources of funds as decreasing the impact that rate hikes will have on
Yeah, partly. I mean, maybe more importantly, I would suggest that I don't think we're going to see meaningful rate hikes anytime soon. If you think back to what we talked about, in the earlier part of this conversation about, a lot of the headwinds that we're seeing, just broadly in terms of the economic environment and particularly abroad, I think a lot of the concerns people were voicing, in 2014 and 15 about normalization of monetary policy, clearly, at best have been pushed way out into the future. I mean, even, Janet Yellen herself over these last, few weeks has effectively said, hey, we're going to take more of a wait and see approach. The balance of risks is not quite what it was in December when we hiked the first time. So I think it's going to be much more of a slow and steady path to normalization. And because of that, the impact on commercial real estate should be modest. There will be some, of course, but it will be modest. Yes? Yeah, I think we're there's an experiment that's going on that seems very unlikely to show up here in the United States, and to the extent that it has longevity elsewhere, I'd be surprised to see it go much further than it already has. Anybody else? So let me just wrap up then with this. First, it's been great to be here back at UF. You guys have unbelievable facilities. This room is amazing. This building's amazing. So it's certainly a lot nicer than when I was here. So you guys should all appreciate that. And more broadly, I would just simply say, you guys have tremendous programs, tremendous faculty here. The people here, at least in the conversations that I've had with administrators and faculty, they care about you, and they care about not just your education and learning concepts and what have you, but they care about you after the fact and getting you jobs. And because of that, I would ask that when you leave this place, whenever that is, you should remember what this place helped do for you. And you should try to give your time and resources to help others behind you. And I will leave it at that. Thank you for your time.